Hello and welcome to episode number 36 of Zach's Tech Talk Tuesday. My name is Ryan McQueeney, and on this week's show, I will be discussing 3 trading ideas for tech investors that want to both stay active during these volatile times and avoid any major impact from the ongoing trade spat between the US and China. Again, I want to emphasize before we jump in here that this is just some ideas I want to kick around if you are dead set on staying active and staying actively trading right now or actively investing right now. I think a lot of analysts and experienced investors would say now is a good time to sit on the sidelines, especially with how long it might take for these trade talks to pan out. And with even though earnings season, as we'll get into, should be relatively strong across the board, especially in the tech sector, earnings season is also still a bit of a risk inherently. And then looking even further down the line into it being a midterm election year, plenty of political uncertainty looming ahead. Again, I really would think a real strong opinion would be to sit on the sidelines for now, wait things out a little bit. But if you don't want to do that, if you absolutely must not do that, I'm going to go over a few ideas I'm thinking about this week. Now, stocks gained on Monday after officials in President Donald Trump's administration downplayed the potential impact of any looming trade war between the U.S. and China over the weekend. The tech-heavy NASDAQ composite led the major indexes after also leading the sell-off at the end of the previous trading week. Key officials in the White House appear keen to remind investors that most new tariffs are not yet in place and the overarching dispute might be settled through negotiations. For instance, on Sunday, National Economic Council Director Larry Kudlow said in an interview that the ongoing trade spat, quote-unquote, might turn out to be very benign. But still, trade tensions are likely to dominate the market's attention for the foreseeable future, especially considering that the discussion period for proposed U.S. tariffs means that the earliest new charges might be imposed is somewhere around early August. Still, it is possible for other factors to outweigh the effect of these tensions, and that brings me to my first idea today: focus on earnings season. It is, in fact, possible that another strong earnings season could inspire renewed confidence in the technology space. According to Zach's director of research, Shiraz Mian, and our latest earnings trend report, total earnings for the sector are expected to be up 20.7% on 11.4% higher revenues. That's based off the latest consensus estimates. And this would follow 24.2% earnings growth and 11.1% revenue growth in the previous quarter. That's really, really strong bottom line and top line growth. Shiraz says, quote, "The sector is firing on all cylinders with the hardware, software, as well as semiconductors industries continuing with the strong momentum that has been in place over the last few quarters," end quote. So really, despite the sudden return of volatility to global stock markets, analysts have become increasingly bullish about the upcoming earnings season. Total earnings growth for S&P 500 companies is now projected to come at 16%, and that would be up from the 14.1% growth that was expected as recently as the end of January. Again, so that's 16% from the broader S&P 500 and 20.7% earnings growth expected from the technology sector, meaning tech earnings are expected to outpace the broader market. And in terms of that revision, the strong revision activity we've seen, earnings estimates trending higher ahead of earnings season. The tech sector and the finance sector are actually responsible for more than half of all positive revisions since mid-December. Still, as I said before, many investors are hesitant to make earnings plays, and that uncertainty is just for a lot of people presents too great a risk. So another strategy that investors might want to focus on is to find stocks that the broader market is inappropriately discounting based on trade fears. One example that I want to highlight here is Micron, and this is something I wrote about last week. And I think that there's a bit of a misconception about Micron's business and these trade negotiations, these tariff wars, that I think is allowing the stock to be a little bit undervalued based on all of this. Micron generated about $20.3 billion worth of revenue in its most recent fiscal year, and a little over 50% of that came from China. So when we look at, kind of strategies for avoiding a trade war between the U.S. and China, it seems that investors were probably pretty justified to sell off Micron, given that 50% of its revenue comes from China. The stock dropped nearly 20% since late March when these tensions really started ratcheting up. So clearly that is, at least part of what was going on here. But if you actually look at the list of U.S. goods that Chinese regulators targeted or are planning to target in kind of retaliation for some of the proposed tariffs that the Trump administration has put out, it includes almost no tech products or technology equipment. And the country is almost exclusively focusing on goods that affect Trump's support base, including agricultural products like soybeans, corn, and meat, cars and vehicles, and manufacturing supplies like chemicals and lubricants. These things are political in nature and really designed to create backlash against President Trump and the Republicans, especially with midterm elections looming. He's really going after deep red states and red areas of the country. And luckily for Micron, its memory chips have not been mentioned yet. I will say, as an aside, that Micron is based in Idaho, and if that deeply red area of the country has voted strongly in favor of Trump in the previous election. If it gets even more tit for tat than it has looked like over the past couple weeks, and the Chinese continue to make things political and continue to go after the support bases I think that they're doing right now, perhaps a specific target of a company based in a place like Idaho could end up happening. We're not seeing it yet. On the other side of this tariff equation is how new U.S. tariffs could affect Micron. So I'm talking about there, and maybe not as much exposure to Chinese tariffs as people might have thought. So how are U.S. tariffs possibly affecting Micron? The White House's list of proposed Chinese goods to target includes a number of components used in the manufacture of semiconductors, and Micron does have manufacturing facilities in China. So, if there's any movements of goods and equipment from China to the U.S., that seems like it could be a problem. However, Micron does not actually have an overwhelming dependency on its Chinese properties. And I just wanted to point out that out of the company's $19.4 billion in net property, plant, and equipment, just $453 million of that is from China. Part of this, and then part of another thing that's kind of an advantage too, is that semiconductor supply chains are notoriously diverse. Micron's own existing supply chain is diverse, and tariffs can really be avoided by making simple adjustments to the chain. So I know that's pretty hyper-specific idea to throw out. I'm just looking at one company specifically, but the foundation of the idea is that there are some companies that, based off of the goods we're seeing right now that have been targeted, aren't actually as exposed to the trade war as the market as a whole might have assumed at one point. So that's the first two ideas I wanted to kick out today. The third and final one I want to talk about is one that focuses on simply avoiding this nonsense altogether. And this strategy is really going to be rooted in small cap techs. Now, I will say, as a kind of forewarning here before we dig in, small caps are going to get punished in a volatile market, just like any other stock, and a lot of times even more so than the broader market as a whole. However, the Russell 2000 has fared better than some of the other indexes lately, suggesting small caps have been better off, and plenty of young domestic tech growth stocks should be relatively unfazed by a trade war. Now, there's plenty of other sources of uncertainty, so it's not just the trade war that could cause volatility down the line. And I think a lot of people would say sit on the sidelines. Small caps aren't worth the risk. But one option I do want to highlight is Paycom Software, a provider of cloud-based human capital management software, delivered as a software as a service. This is checking off a lot of the boxes we're looking for in some of these high-flying tech growth picks. It's a cloud play. It's a software or human capital management software. It's really, using cloud tech to help the way businesses interact with people different, or help them kind of grow and advance the way they interact with people. This type of tech pick is not really going to necessarily be affected by trade war volatility. And as one of the fastest growing public companies in the world, Paycom is looking uniquely interesting right now. Analyst sentiment for Paycom is noticeably strong. Within the past 60 days, the company has witnessed 11 revisions to its full-year EPS estimates, with 100% agreement to the upside. And this positive revision activity has earned the stock a Zacks rank number 1 strong buy. Getting into some of that growth I mentioned, we expect the company to witness EPS growth of 89% and revenue growth of 26% in its current fiscal year, based on our latest Zacks consensus estimates. And looking even further ahead, Paycom is projected to improve its bottom line at an annualized rate of nearly 25% over the next 3 to 5 years. This is an Oklahoma City-based firm. It's an American company, going to be doing most of its revenues in the U.S., so certainly one that it doesn't have exposure to the trade war, as I mentioned. Those are my 3 ideas, guys. And just to recap, that's, first of all, sit on the sidelines if you're not thinking about the risk. So maybe that's 4th idea and perhaps the most important one. But to recap the other ideas I ran down, earnings growth is going to be strong in the tech sector here. We'll start to see that within the next couple weeks. So keep your eye on anything interesting developing over earnings season. Focus on, or try to find, fun stocks like Micron that are being discounted amid all this trade war rhetoric that actually might not have as much exposure to tariffs as one might think. Or, if you absolutely must, small caps have fared a little bit better recently, and there's plenty of small cap tech growth options that should not be directly affected by the trade war. As a reminder, if you feel that we missed something, or if you want us to cover a different story, shoot us an email at podcast@zacks.com. Also, make sure to check out all of our other audio content at zacks.com/podcasts. And remember to subscribe and leave us a rating on Apple Podcasts. As always, thank you for listening to the Zacks Tech Talk Tuesday. We will see you next time.